You're underweight Italy at the moment, but are you waiting for any interesting opportunities to open up?
Yep. I think we were underweight Italy, given how much spreads have tightened since the beginning of the year. Yes, we've given back some with the uncertainty about the government, but Italy's had a good year. So we felt that now is the time to trim our sails a little bit in terms of Italian risk. It doesn't mean that we won't get back in. What we were expecting was for that volatility to happen in September or in October, where we were going to have the discussions about the budget. It's come a bit sooner, given what Salvini is trying to do. So there are interesting elements to look at, particularly in the credit markets. We were talking about banks a little earlier on. They've been issuing in the non-preferred senior space, for instance, and it's nice, short-dated, and it's got a bit of spread to it. In this low-yield environment, that can be an interesting opportunity for a fixed-income portfolio. So we're keeping an eye on it, seeing where spreads get to, and underweight at the moment.
What do you think about industrial debt? I mean, when you look across Europe, there are concerns in the stock market about, for example, the auto industry. What does that trade look like from the credit side?
From the credit side, some of those spreads still look tight from my perspective. If you look at the auto sector, it's still an area that is in transition. It's still got its work cut out at the moment. So we're cautious in that space. We're starting to see some opportunities open up, and we're keeping an eye out on. But for me, it's still a difficult sector, and it's still because of the rally that we've had in spreads so far this year, not quite there yet.
I mean, junk bond spreads in Europe have widened to the widest in 2 months. So I'm wondering whether you see an opportunity there just because of the widening, or whether you prefer to stay in quality and maybe shorter duration.
Now, the junk bond market has been an interesting one, actually, because you've already had a sort of favoring of quality in the junk bond market. What has actually performed is the upper end. It's the double Bs. Single Bs have had a trickier year this year, as investors have shunned some of the more difficult credit names. And that's been driven by rates and by spreads on the double B side. So we've already seen a bit of dispersion from that perspective, and be it in terms of rating, but also in terms of names. You really have to be a bit careful as to where you go. So it has been a high quality rally.